across to Pawan Parakh of Renaissance Investment Managers. So, Pawan, thanks so much. It's your first interaction with us. Let's just start with what is the sense that you get in terms of bottom-up ideas in the market? After the recent rally, you believe that a lot of mid-cap companies, a lot of so-called sector leaders, but maybe the size in the market cap may not be high. Those are the ones that one should focus on in this rally, and that's also been the style what Renaissance follows.
Hi, Pankaj. Thanks for having me here. So I think as far as markets are concerned, for the last 6-9 months or so, we've been very positive on the markets, and we believe that sectors which are linked to the core economy should do well. So sectors like banks, capital goods, chemicals, auto, these are sectors where we positioned ourselves. We think the domestic economy post-COVID has healed well, and as things pass, our confidence only keeps on increasing. As far as the capitalization is concerned, so irrespective of the market size, one thing that we are very clear is that we want to invest into quality names across market caps, be it large caps or mid caps. And if you look at the long-term track record, these are the kind of stocks and sectors which have leadership skills. These sectors tend to deliver superior performance over a long period of time.
Good afternoon, Pawan. This is Shell also joining on the other side. You did mention about the sectors that you're liking, that's banks or capital goods and autos linked to the domestic economy. But let me talk about banks in particular, and that area is very vast. It's problem of plenty when it comes to the banking sector. You have the private sector bank, the PSU banks, the large caps, the mid cap. All of them somehow are looking pretty good. Where is your focus primarily in the banking space?
Right. So we are focused more on the private side. Our exposure on the public sector is largely limited to the top 1 or 2 names. And the private sector also, our exposure is typically large banks which have got very strong liability franchise. And I think that is even more important in current scenario, wherein the cost of deposits are increasing, and the ability of the banks to pass on to its asset side customer is very important. So large cap banks, and on the mid-sized banks, we typically focus on banks which have got higher exposure to secured portfolio because we think that is a safer haven versus venturing into high growth unsecured books.
Right. So one, of course, is banking names, how they benefit from economy and the triggers that you mentioned. Second, of course, is a lot of these companies with commodity exposures have not done that well. But now commodity prices are coming down. Overall cost of production probably should reduce with the sort of move that you've seen across commodities. How should one play that? What will be the best way to play it? Should one look at FMCG names which get a direct impact? Should one look at QSR names where price hikes have happened and probably cost would come down? How would you look at the commodity fall play in the market?
Right. I think the best way to play commodity is, some of the users of commodities. So as you rightly said, some of these FMCG names or QSR names. But the only problem with these two names are that these are very expensive. The entire bouquet of stocks which fall under this category is very, very, very expensive. So, you can rather play it through, say, for example, a building material space or maybe through a capital goods space. Again, these are sectors which are consumers of commodities. But these are companies wherein you have got multi-year growth visibility. And as far as valuations concerned, we think valuations are fairly reasonable as of now. And more importantly, some of these sectors, say, for example, building materials in specific, also benefit from recovery in real estate plus infrastructure. So I think these are the sectors which you should rather focus to play on the falling commodity prices.
Right. Pawan, what's your view on the new age tech companies? Do you have a coverage on them, and which of the companies that you like in these particular sector?
So we are monitoring all the companies and not investing in most of them. Because as far as our philosophy is concerned, we like companies with strong cash flows and ROE. Unfortunately, none of these companies have got those features. And more importantly, the bigger concern that we have is that, some of these companies are, pulling down their losses. The losses are coming down. But more importantly, you still don't know when they will be profitable, what will be the growth outlook then. And just being profitable doesn't justify the multi-billion-dollar valuations that they are commanding as of now. So we are staying away from them. We just have exposure to 1 or 2 names. But once again, those are companies which are profitable, leader in space, and high cash flow companies.
Right. One space that, we all are talking about in terms of commodity, maybe like a steel company, a metal company, a paper company, how would you look at it? A lot of niche mid-cap steel, metal companies, but they have paid down their debt quite a lot in the last 3 years. So how would you look at that situation where earlier people were factoring in that debt servicing could be an issue, but now a lot of companies within these sectors, maybe paper, maybe sugar, maybe various other sectors, which have seen problems for last 6, 7 years in terms of debt increase. How to value that in this market?
Right. Interesting. Actually, that is one very important factor that I've also been monitoring for last about 6 months or so. And if you look at sugar companies specific, they had a cycle 3, 4 years back, and the cycle was favorable, and most of the companies paid down their debts and were now sitting on comfortable balance sheets. I think steel is also going through a similar cycle over the next 3, 4 years, despite their capacity expansion plans. We believe that these companies will be able to reduce their debt to comfortable levels. And once that happens, I think, the cyclicality, I mean, steel is a very cyclical sector. When you have leverage, it makes it even more deep cyclical, right? So that deep cyclicality nature of that sector will wane away. And I think that is good as far as, we as investors are concerned.
Right, Pawan, we leave it there. Thank you so much for joining us on the show to give us a glimpse of which are the sectors that you're pretty bullish on and which are the ones that you're avoiding at this juncture. That was Pawan Parakh, who is the Director and Portfolio Manager at Renaissance Investment Managers. But on that